Hotel and motel financing explained, and understanding hospitality financing in today's market. Hotels and motels represent one of the most unique and potentially profitable sectors of commercial real estate. And unlike office buildings or retail centers or industrial properties, hospitality assets generate revenue daily through occupancy and room rates, making lender underwriting significantly different. So, whether you're purchasing your first motel or refinancing an existing hotel or acquiring a flagged franchise hotel property or planning a renovation project, understanding hotel financing is critical to securing favorable loan terms. The good news? Well, in today's commercial lending marketplace, we offer numerous financing solutions for hospitality investors and owner operators. And at CommLoan, borrowers gain access to a nationwide network of hundreds of lenders through our Cupid lender matching platform, which helps identify lenders that are actively financing hospitality properties. And CommLoan's technology driven marketplace connects borrowers with multiple lending sources and loan programs, streamlining what has traditionally been a fragmented lending process. So, why hotels are different from other commercial properties? And hotels are considered operating businesses as much as they are real estate investments. And lenders evaluate occupancy rates and average daily rate or ADR and revenue per available room, commonly known as RevPAR. But most importantly, your net operating income or NOI and the resulting debt service coverage ratio or DSCR, but also the franchise affiliation, the management experience, and the market demand drivers. Because hotel income can fluctuate daily, lenders typically view hospitality properties as higher risk assets than multifamily apartments or single tenant retail properties. And as a result, hotel loans often require larger down payments, strong sponsorship, hotel management experience, detailed operating statements, and market feasibility analysis. So let's talk about some common types of hotel financing. You've got conventional bank loans, and traditional banks remain a popular source for hospitality financing. And these are best for stabilized hotels with experienced operators and strong cash flow properties. And typical terms for something like this would be 65 to 75% loan to value and a 20 to 25 year amortization with a 5 to 10 year fixed period and competitive interest rates. There's also SBA hotel financing, and many hotel acquisitions qualify for SBA financing. And the benefits include a lower down payment, a longer amortization period. It's for owner occupied properties. And it's for franchise hotel financing, flagged hotels. And SBA financing works especially well also for boutique hotels and limited service hotels and small motels and family operated hospitality businesses. But there's also CMBS loans, or commercial mortgage backed securities, or CMBS lenders actively finance larger hospitality assets. And the advantages there are it's a non recourse loan option with higher leverage and long term fixed rates. And these are best suited for stabilized hotels and larger hospitality portfolios and institutional quality assets. But there's also debt fund and bridge loans, and bridge lenders can provide financing when traditional banks cannot. And some common uses could be to fund renovations or franchise conversions or a value add acquisition or for distressed hotel opportunities or for short term repositioning strategies. And bridge loans often close significantly faster than conventional financing ever will. Life insurance company financing. Life companies focus on premium hospitality assets with strong sponsorship groups and in high quality markets. So, benefits include probably the most attractive interest rates with long amortization and a flexible structure. So, let's talk about hotel property types that lenders will finance. In hospitality, lenders may finance limited service hotels, So some examples of brands you may know would be, say, a Holiday Inn Express or a Hampton Inn or a Fairfield Inn. And these are often viewed as lower risk due to the reduced operating complexity. But also full service hotels. So some examples would include, say, a Marriott or a Hilton or a Hyatt. And these require stronger underwriting because it has a food service component and conference facilities and larger staffing requirements. But also for boutique hotels. See, these are unique properties with strong branding and local appeal. And lenders carefully analyze market positioning as well as operational performance as part of their due diligence. So extended stay hotels is another category. And these are increasingly popular due to longer guest stays and stable occupancy. But there's also independent motels. And these can be financed successfully, but often require stronger borrower experience and property performance. So let's talk about what lenders look for. Occupancy. And most lenders prefer, say, a 60 to 75% or higher occupancy with stable historical trends and revenue performance. So lenders are going to look at your average daily rate or ADR, your revenue per available room or RevPAR, but also your gross revenue growth. Debt service coverage ratio or DSCR. Most hotel lenders seek a minimum 1.2 to 1.35. My experience, banks are 1.35 north. But they also look at that DSCR, and experience is another category. And experienced hotel operators will receive better terms and higher leverage and faster approvals, and often prefer franchise affiliation. And these national brands often improve your financing options. So if you're looking for a hotel, think Marriott, a Hilton, a Choice Hotel, a Wyndham, a Best Western. So let's talk about typical hotel loan structures. While every lender is different, common parameters include an LTV of, say, 65 to 75, an amortization of 20 to 30 years, a DSCR of 1.2 to 1.35 or higher, and potentially with recourse, 5 to 10 year term, a loan size 500K to 100 million. So let's talk about some challenges in hotel financing. And hospitality loans can be more difficult due to their economic sensitivity and seasonal occupancy fluctuations and management complexity and labor costs and their franchise requirements, and if they're on a property improvement plan or a PIP. And many borrowers waste months approaching lenders individually, only to discover the lender really doesn't finance hospitality assets. So let's talk about why lender matching matters. And commercial financing is still highly fragmented, and different lenders specialize in different categories. So one might like a limited service hotel or a full service hotel or a boutique property or an extended stay asset, but all love franchise hotels. And there's also independent motels. And CommLoan's Cupid technology helps borrowers identify lenders whose programs actually match the specific property type, loan size, and borrower profile, which provides access to hundreds of lenders through a centralized platform. And rather than calling banks one at a time, borrowers can leverage me and our lender matching technology to accelerate the financing process and improve loan execution overall. So, final thoughts for the day. Hotel and motel financing remains one of the most specialized areas of commercial real estate lending. And the right financing strategy depends on the property type, the market conditions, the operational performance, the borrower experience, and the business plan. So whether you're acquiring a limited service hotel or refinancing an existing hospitality asset or renovating a franchise property or expanding your hospitality portfolio, working with a platform that can provide you with access to hundreds of lenders can dramatically improve your financing options and your speed to closing. Hospitality investors who understand lender requirements and leverage and the right financing partners that work for them can position themselves to capitalize on one of commercial real estate's most dynamic asset classes. And that, my friends, is it for the day. Thank you for watching. Please visit my website, billrapp.commloan.com. You can price an asset and schedule a consultation so we can have a conversation. Thanks for watching.